Hey, what's going on, everyone? Good afternoon. Welcome to today's webinar on group investing and opportunity zone funds. Hope all is well. Hope everybody's having a great day. We're gonna have a fun hour talking about group investing and opportunity zones. This is a follow-up to the presentation I did last month. We're kind of doing a 3 or 4 part series on group investing and opportunity zone funds. A lot of people, reaching out say, hey, we missed the last one. Please do another one. So we're going to keep this train rolling, and hopefully that you get some tangible information that you can take and either think about, putting together an opportunity zone fund, join someone who's doing an opportunity zone fund, or at least know the ins and out of what's going on in your area or in areas that you're interested in investing. And so I think this will be very informative. We're going to start off talking about what group investing is in general. We're going to break that down. Then we're going to get into the specifics as it relates to opportunity zones and what are some of the opportunities, particularly for you or people that you're working with. And then we'll talk a little bit about an opportunity zone fund that we're putting together here in Oakland on a couple of projects that we're very, very excited about. So we'll hang out for a couple minutes, let people fall in, and then get into the brunt of the presentation. Again, by the way, we're going to put this recording on YouTube. It'll be up tomorrow on YouTube. And if you have not subscribed to the Affinity Investments YouTube station, please do, because we're putting out content, at least 2 to 3 videos a week as it relates to real estate, also giving you some good business tips as we see, markets needing more business skill sets out there, and we're going to be things that are relevant to us. We're going to be putting it all on our YouTube station. So if you want to stay tapped in with our content and what we're doing as a company and as an organization, please subscribe to that YouTube station. Okay. And also, we also want to keep you informed of our properties that we're working on, regular property tours, updates. So again, stay tuned and tapped in with us in that particular platform on YouTube. So that being said, why don't we get into it and dial into that. First thing, I know a lot of people may be dialing in, may know me. People on the internet, may not. So I always make a point to introduce myself. My name is Steve Peterson, the broker owner of Infinity Investments. We're a boutique commercial real estate investment firm based in Oakland, California, and we were started in November 2009. And that was a very interesting time to be doing real estate and starting a company, but actually it was a great time. And as we are going through a weird time, weird is a lack of a better word, in this pandemic, in this global crisis, just remember, some of the greatest opportunities arise when there is a shift, when there's change, when there's crisis, when there's problems that need to be solved. So that's what I saw in 2009 when I started this company. We were right in the storm of the Great Recession, but I saw properties being sold pennies on the dollar, and I figured it would be a great time to swing the bat and start my own firm. So we started then. Now I also had the honor to serve as president of the Associated Real Property Brokers, which is the Oakland chapter of NAREB, as well as the California Association of Real Estate Brokers, KRAB, which is the state board of NAREB. Many of you don't know, NAREB stands for the National Association of Real Estate Brokers, which is the Black Real Estate Trade Association. We're formed in 1947. And we stand for democracy and housing. We stood for democracy and housing back in 1947. We championed all the fair housing laws, and we stand for democracy and housing today. And our charge today is to bridge the wealth gap that exists, the serious wealth gap that exists in the Black community. And we're doing that through promoting home ownership and investment property ownership. So it was truly an honor to serve as president of those great organizations, as well as in 2018, I was the president of NorCal CCIM. And CCIM stands for Certified Commercial Investment Member. That's a designation that you get in the commercial real estate world. But more importantly, it's a network of people, of great people, top level professionals who earn the designation, who are in the pursuit of the designation and are just essentially in the pursuit of excellence in the commercial real estate field. I had that honor to serve as president in 2018. And so those roles also kind of helped me to shape my executive prowess, if you will, and learn how to be a better leader, learn how to be a better entrepreneur, to deal with people, to have some fun, and to do some deals, because we did a lot of them. So thank you guys a lot. At Infinity Investments, we focus on multifamily properties. That's our sweet spot. We do office, other commercial properties, but multifamily is what our specialty is, particularly mid-sized apartment buildings in the Oakland Bay Area. So looking forward to networking with you guys for sure. And I'm asking you, I would ask you if you have a question, if you have a thought, to chat it in. And then at the end, I'll wrap this up about 12:50, and I'll leave 10 minutes to address your questions, to address any comments that you might have, any of your thoughts. I really would love to hear from you guys. But I'm going to kind of get to it at the end. That way I don't break the flow of, the presentation. So hopefully that's cool with you guys, and let's rock. Okay. What is group investing? Essentially, it's when two or more investors get together to acquire a property. They effectively are a group that owns the property. The structure, however, can take many different forms. Okay, but the bottom line, group investing is when two or more people get together and buy property. Ever more popular now, even in the single-family home world, where people are wanting to, own properties, but maybe the average price is $700,000, or is unattainable essentially. So even in people buying homes, what they're doing is buying them together. Okay. Now we're talking about is investing, and the group investing has been done, thousands of years, just pooling your resources to get things done. Now the structures though is what is very vitally important. Okay. The worst structure that you can do a group deal in is what's called the joint tenancy or joint. The joint tenancy is the worst way to own property, in my opinion. I still see it done today. It is not a good way to hold title. If one person passes away, the interest of that person goes to the other tenant, not to their heirs. Not a good way of owning property. And just the breakdown of the structure is not good for legal protection. It's not the best tax management. However, it's a method that's done. Tenant in common ownership is a little better. Well, it's a lot better actually. And it's where each owner has a percentage of the property. They have a percentage of the property's deed. So let's say there's 4 owners to a property and they all equally own 25%. They have 25% of that deed. Tenants in common is a great way to own a group, and it qualifies for a 1031 exchange. General and limited partnerships are kind of a thing of the past, although I've seen limited partnerships make a comeback in the world of group investing and entity ownership. However, limited liability companies, LLCs, are more prevalent and more popular, and I just think have a better flow of operations, and also has the tax flow through that is really beneficial for groups. So that's what I advise. I think if you're going to put together a group, here's what I really advise: is that you seek out an attorney who's an expert, not just the average attorney who's out there, but an expert attorney in structuring entities, and particularly has a lot of experience in structuring entities in a group. All right. Now, real estate investment trusts are the world of the institutional investors. Typically, I believe you got to have over 100 investors. This only makes sense if you're buying large institutional properties and you have a large amount of investors, and you possibly want to take your company public, which some of y'all might want to do that. So that's an option. Community land trusts are popular in the Bay Area and Los Angeles. It's more of a kind of a nonprofit type structure, and really is designed to land bank or to control properties in a particular area for a purpose. All right, and opportunity zone funds, last but not least, is what we're going to be talking about today, and I'll get into that more down the line. But these are just some of the structures. Now, there's more. There's more to this. This is what's popular. This is what's prevalent. This is what I see. But bottom line is there needs to be a structure. You can't just get together and say, hey, we're all going to own these properties in our personal name as joint tenants. It's not a good way to do it. You need to get some guidance and advice on how to structure it. All right. And I think that's going to become more and more prevalent as we enter in this new economy post-pandemic, if that's even a thing, post-pandemic. I don't know how long this thing is going to last, but coming out of this, or just moving forward, I think group economics is critical, not just in real estate, but particularly in real estate, but in all avenues of business. Okay, so why would someone invest with a group? First of all, you can buy more property than you would be able to if you bought by yourself, right? Some people you may not be able to buy by yourself, or you don't have the resources to buy alone. So it makes sense to get with other people who maybe have some resources that you don't, and maybe you have something that they don't, so you can have a collective experience and a better chance for success. Now, also, you limit your liability to only the capitals that you invest, eliminating, essentially, depending on what we're talking about, but for passive investors, eliminating the mortgage risk and the property operational risk. So in other words, let's say you passively invest in a group. Now your only liability is the capital that you invest. People say, wait a minute, that's the main liability. That's one of the main liabilities is the capital you invest, but anybody who's had to deal with a mortgage that was upside down, or a mortgage that was called, or a mortgage that was a short-term loan, and you weren't able to refinance or sell, there's a significant risk in obtaining a mortgage. And also, when you operate the properties, people slip and fall. People, oh, there's mold, there's something, there's an operational risk, okay? And that, you have insurance to make sure you take care of that. But as the passive investor, you don't have to worry about that. You don't have to deal with it. The person putting the group together, though, I want to put that out there. That person is typically liable for the mortgage, is on the hook for the property operational risk. That's why you want to make sure you find a good deal. You got your ducks in a row to make sure you're doing it. All right. Now, you can also eliminate the management hassle and responsibility. A lot of people who end up joining the groups have just saying, hey, I'm a busy professional, I'm busy with other properties, or I'm busy with just life in general, or I just don't want to manage properties. I'll put money with whoever the sponsor is with the group because they don't want to deal with the management hassle and responsibility. All right. And the key here is that you leverage in a group that wins, you leverage the strengths of the members of the group. So some person may have a great property management experience. Some person may have a construction experience. Somebody may have a finance background and connections to bring better financing in, bring more investors in, learn how to structure things. Somebody may just know how to really find excellent deals and then sell them for top dollar when it's that time. You figure out what people's strengths and weaknesses. Somebody just might have a ton of cash and know how, but you know how. So you're leveraging the strengths of the members to generate truly passive income. And that's really the positives. Now, I'm always going to keep it real with y'all. There's cons of group investing, all right? And the first thing is that the investment is illiquid, all right? It's illiquid in nature, meaning that you can't just call a stockbroker tomorrow and get all your money back, right? That's not how real estate works at all, though. So even if you buy a property outright, it is illiquid in nature. You have to go through a marketing process, a sales process, escrow. Even if you want to sell your property and you get an all cash buyer, still got to go through escrow. They've still got to get inspections. It's a process, so it's illiquid. That's the biggest thing. Now, transfer of individual ownership interests can be complicated. So let's say 4 people own a property all together, and one of them wants out, right? But the rest of the group says, nah, this is a good deal. We want to stay in. That can be a little bit tricky. Now, you can sell your interests if you own a percentage in an LLC or whatever the structure is. However, that can be complicated and typically requires the approval of the other partners in the group, right? And it's not like you just put that on the market, on the real estate market. Say, hey, I got 25% of the building, come sell it. It can be done, it can be sold, it can be marketed, but the bottom line is it's hard. Most people out there looking to buy, they want to buy full property, not a percentage of the property. Just saying that it can be done, but it's not easy. And then I think the biggest thing is that you lose complete control of the operations. For instance, let's just say, hey, there's 4 people in that group. You're the person who says, hey, I want to get out of the group. I got another life situation. I need money out. The investment's illiquid. The team can say, well, look, that's not part of the deal. We bought this. We want to be in for 5 to 10 years. You want to get out in 2 years. That ain't what we signed up for. So 3-1, we want to keep it. You want to sell it? Well, just lost the vote. All right. So you still have rights. You still can vote. Your opinion is valid, but you don't have absolute control like you would have if you just own the property by yourself, because you can make those decisions by yourself in that situation. That's a key to remember. All right. Now, also dealing with partners can be difficult. Bottom line is people have different personalities. Some people mesh well, some people don't. Some people are bugaboos. They want to call you, every week to see, hey, how's it going? Some people may not respond at all. You need to make a group decision and you can't get a hold of somebody. And you're dealing with somebody might just be one of those people that you just, it's laborious to have a regular conversation with. So dealing with partners can be difficult, and decisions to refinance, to sell, to hire a manager, to fire someone, that is a collective group decision. So those are the negatives. Now, it's the same thing whether you're building a business, buying real estate, running an organization, though. You're working in a group. It's some pros and cons, guys. You're working in a team. There's some pros and cons. All teams are not equal. Some teams are great. Some teams is, right? Look at any sports. There's usually one champion at the end, and usually someone who gets the first round draft pick because they were all bad. So the same thing happens in real estate. So you want to pick your partners wisely, not just based on, if they got the cash or they got the credit or whatever, but that you can mesh well with this person, you can work with them, you guys can figure out how to make decisions even when you don't see eye to eye. That I think is important in all relationships, especially husband, wife, friends, best friends, groups, teams, figuring out how to make a decision when you don't agree. That's important, and you got to set that up. That's why getting the proper structure of your group is critical, and having an attorney to set it up, because you're not always going to agree on things. And you don't want that disagreement to turn into a war. You want to figure out how to resolve the issue and move past it. So those are just a couple of pros and cons about it. I hope you take that with a grain of salt. I still believe there's a lot more benefits than that. I believe the benefits outweigh the risks in this, the cons. So I think it's worth doing. Now, let's move on and get a little bit more technical here. So group investing essentially is what's referred to as a syndication, okay? And the words are kind of synonymous, and meaning that they mean the same thing, basically. So here's somebody talking about, hey, I'm gonna put together a syndication. They're gonna raise money and go acquire a property with at least 2 or 3 people, right? And so the syndicate, maybe definition of a syndicate is a group of people who form an association to undertake a business transaction. And that's referred to the business in the book, It's a Whole New Business, page 24, written by the author Gene Trowbridge, CCIM. And Gene is an attorney, he's the best attorney that I know in the world of syndications. And he literally wrote the book on syndication. It's a Whole New Business. And so check that out if you got time, because that is an excellent book. There's also an updated version to that book, but if you go on Amazon, check that book out. It's an in-depth read, but it is worth your time. He is an expert. You get that book, you are gonna know, and you're gonna feel like you're an expert in regards to the world of commercial real estate and the syndications. Okay, and just an example, if you want to buy a 20-unit apartment building, that costs you $2 million. If you don't have the resources to do it, you can form a syndicate. And let's just say you went out and found 10 investors who all put up 200 grand to buy the property. That is great, because now you don't have the debt risk. You don't have the mortgage. That's a lot harder to do, though. But essentially, that's a great example of what you would do when you wanted to buy the property, didn't have all the capital, and you maybe had some resources, though. You had some connections, and you go talk to them about making this investment with you. Now, the key to syndications is raising money and being able to do so efficiently and swiftly in a way where you, again, connect with investors who have like minds, or investors that you can work with. And that's not everybody. So you really need to have a good pipeline if you're going to do this. And you have to have a network if you're going to do this. You have to have people that you're connected with and that you're linked up with and that you can do business with. Okay? So I say here that the rules of raising money have changed as a result of the Jobs Act of 2012, which has basically created a way for small businesses, small entrepreneurs and startups to raise money via advertising, okay? And that's where we hear the term crowdfunding, which has been around forever, but it really has blown up after the Jobs Act of 2012, because it made crowdfunding, popular online. So essentially, if you wanted to raise money for a business, enterprise, or piece of property, You could set up your crowd fund, connect with one of the platforms, or you can set up your offering, connect with one of the crowdfunding platforms, and now you can start raising capital on the internet. Whereas before, only people who could raise capital through advertisements had to be, registered securities. And that's a big deal. Now, I still think though, that being the case, I still think the best way to raise money is through, connecting with people, essentially through word of mouth. Now, here's some different methods to be able to do that. Networking at real estate seminars, trade shows, events, and mixers. Now, we in the pandemic, all right? I don't know how many billions have been lost in the world of business conferences, trade shows, events, mixers. I know that that is a huge way here in the States and throughout the world of how we connect with each other in any industry, particularly in real estate, but in any industry, this is a huge way of how we connect with each other. That's going right now. These conferences, trade shows, seminars are not being held in person. However, we are all pivoting and doing what we can online. And so what we're figuring out how to do, the different networks, groups, organizations, companies, we're figuring out how to network online. So for instance, one thing you can do on a meeting like this is maybe throw in the chat, hey, I'm a new investor. My name is such and such. You can reach me on my Twitter handle, Twitter, Instagram, LinkedIn, YouTube, whatever. And I invite you on the chat now. If you've got a business, if you've got a enterprise, you want to connect with other people on this meeting or also on YouTube, throw it in there, throw it out there. Because I've done these seminars since 2011, and we always start with at least 15 minutes of networking. And I really I really make it emphasis for people to meet each other and exchange contact information in this way, because that is one of the best ways that I built up my network and my database, going to a million different seminars, learning a lot, more importantly, connecting with the people in the same room. So please do that. All right. And that's a great way to connect with people who might have an interest in doing business with you. Also, if you're running another business, running a brokerage, if you're somehow engaged with clients, your pre-existing business acquaintance could be a great source of people who already know, like, and trust you, and might have an interest in investing in what you're doing. All right. Also, current or past clients. For instance, okay, you sold somebody an apartment building, things went well, and now you want to buy an apartment building. You might want to reach out to them. Hey, I know you got a building. I'm looking at buying a building, putting together some investors. Are you open to opportunities if they make sense? Something to that effect. Also, referrals from clients, attorneys, accountants, people that are handling capital for people who got money. Also, and on that note, wealth managers and financial planners can be a great resource. Now, you gotta be careful here, because a lot of those people are licensed. They have rules about getting investors into other deals. But what happens is, a lot of times people are managing people's wealth. They're taking care of their stocks, their bonds, their insurances, what have you. And a lot of people believe in buying real estate. A lot of planners and wealth managers believe in buying real estate. So they may want to know you, and they may put somebody in contact with you if you have developed your name and built a level of trust and rapport with these people. So that takes time, which is why networking is critically important. Just now we have to pivot a little bit and figure out how to do that online versus how we used to do it in person. Okay. Also, current property owners could be a great source of partners. They own a bunch of properties, and especially folks that are older and maybe looking towards retirement and don't want to be actively engaged in the business that much. So the last one I would say is engaging a crowdfunding site to market your offering. And that's because that is the advertising way of doing it. It's a mass media way of doing it. It's a great tool. However, I still think the other ways are more effective, because again, it goes into developing relationships, developing trust with people. So check that out. All right. Now, who are some of your prospects? Who are some of the people who would be ideal for investing or investing into a group of syndication? For people who've got self-directed IRAs, meaning that they've set up a self-directed individual retirement account where they can make decisions about their investment versus just the investment manager making decisions. This is huge because these folks, are typically a little bit more entrepreneurial within what they invest in. And so what they're doing is looking at investing in something that's not your typical mutual fund or stock. And that's why they set up this IRA. They also are long-term investors. The IRA, the way it works is you take any money out of it, you got to pay tax. So what they're doing typically is the money they make, they're reinvesting it into the IRA, building up that war chest of capital. Great source of potential partners. Also, people who are conducting 1031 exchanges and looking to receive passive income, meaning that they sold the building, now they don't want to pay taxes, they're exchanging it, and maybe they've reached a point in their career where, what they're doing that they just want to be more hands off. So if they link up with you, you can maybe manage the investment and they can receive a rate of return. Very much like the busy professional who has capital to invest, but a lack of time and expertise to acquire and operate their investment. Again, the common theme there is time. People may have money, but they don't have time, especially in this, before the pandemic, in our world is a fast-paced environment. A lot of people got money, they don't got the time or expertise. So if you spend your time gaining expertise, finding deals, either learning how to manage them or linking up with someone who knows how to manage them, you create value to the marketplace. The marketplace of people who've got money and capital but don't have the time and expertise. That's critical. All right. Now, also, another thing to remember is that there's always going to be ambitious investors out there seeking to do projects larger than what they can do themselves. And so they may be typically used to buying properties on their own, but know that, hey, if they want to go to the next level, they need to link up with some people. And you might be that person listening, okay? And it might be time for you to set up a syndicate yourself. So also these people, if you're setting up a syndicate, can be a great source of people to reach out to, all right? Now, and this will leads into opportunity zones, people who have realized a capital gain. So they sold, we talked about 1031 exchanges, but outside of real estate, let's just say you sold some stock, made a ton of money. Well, you got to pay capital gains on that. So a way of, deferring those gains is to roll it into an opportunity zone. Or say somebody, you sold your company, again, made a ton of money, but you got to keep that capital invested if you're going to defer capital gains. You can do that in the opportunity zone. Somebody who sold a collectible or precious metals or something where they just received a gain, typically those investors want to reinvest. And so if you can figure out a way of connecting with these people on a consistent basis, then what happens is now, and if you figure out how to structure one of these opportunity zones, if you will, you got a nice streamline of people who would want to invest in what you're doing. All right. Now, that is a perfect segue into the opportunity zone piece. Now, I hope this, if you do, again, have any questions on just the group investing piece, that's the foundation. Chat them in. I will get to it at the end of the presentation because that's very important to understand. That's why I do it first before we transition into the opportunity zone and the opportunity zone funds, okay? Because all that is, all what we're talking about with the opportunity zone funds is an element of a syndication. It's an element of a group investing, right? Now, so there's two things I want y'all to understand. There's opportunity zones, and then there's the opportunity zone funds. Two different things similarly related. First, what is the zone? By definition, the opportunity zone is a designation created by the Tax Cuts and Jobs Act 2017, allowing for certain investments in the lower income areas to have tax advantages. And how that's defined by lower income areas by the census tracts. And the federal government has set up these zones throughout the whole country in all cities and even in urban areas. They've figured out where the lower income census tracts are. That's how they figure out the lower income. All right. And the purpose supposedly of the program is to put capital to work that would otherwise be locked up due to the assets holders' unwillingness to trigger a capital gains tax. Meaning that people have a building, a business, an operation who maybe want to sell it, but don't want to pay the taxes. typically just hold on. They just say, well, I mean, I would sell it, but I don't want to pay all that money in taxes. State of California, when you combine federal and state capital gains, depending on your tax bracket, I think the lowest you're going to be is 30%. It could be all the way up to 45%. Let's just say you made $1 million or something and you had to pay 45%, $450,000. You have to ask yourself, does it really make sense to have sold that asset? Because you almost paid half in taxes. And for most people, the answer is no. So there has to be a vehicle in which you can defer those capital gains. So the opportunity zones are the census tracts, generally composed of economically distressed communities that qualify for the opportunity zone designation. Now, this is according to the criteria outlined in the 2017 Tax Cuts and Jobs Act. All right, that's what the zones are. A lot of times people got the language wrong. They're saying, hey, I'm going to invest in the opportunity zone. I'm going to put the opportunity zone, we'll do this opportunity zone deal. The opportunity zone is just the area. Understand that. It's just simply the area. What's important, or I said it, I shouldn't say what's important. The zone is important too. But what's critical, particularly if you're talking about making the investment, is investing into the opportunity we're setting up. Opportunity zone fund. Because this is the investment vehicle that you invest in or you take money in that you then go and disperse into the business, the property, the enterprise that's located into the opportunity zone. Big thing I want to point out, a lot of people are getting confused about this, and know that the zone and the fund are two different things. The fund has to invest to projects inside the zone, but they're two different things, all right? Now, to access, I'll break it down. To access the tax benefits, investors must invest into these opportunity zones, specifically through the opportunity zone fund. And a qualified opportunity fund is a U.S. partnership or corporation, like we just discussed, that intends to, interesting word, intends to invest at least 90% of its holdings in one or more qualified opportunity zones. Because opportunity zones are intended to stimulate positive growth within designated communities, there are restrictions on the type of investments in which the opportunity zone fund can invest. These investments are called qualified opportunity zone property, which is defined as this. And it doesn't have to be real estate, real property, but it's a qualified opportunity zone property, which is number one, partnership interest in a business that operates in a qualified opportunity zone, or stock ownership in business that conducts most or all of their operations in the zone, and or number three, property, actual real property, real estate located within a qualified opportunity zone. So these are the three properties, if you will, because it doesn't have to be, again, it doesn't have to be real estate. It can be a business in the zone. And that's another thing I want to point that out, because a lot of people only think it's the properties. It can be, like we just said, partnership interest. It can be stocks, but that's the company, the partnership, whatever, has got to be doing business in the zone. All right. Now, here's the thing as a sidebar. I think that if you're going to be conducting these, a lot of these, this is set up of the corporations of the world. They're simply moving money into these areas, tax benefit. They're not really concerned with the growth, the positive growth and stimulation of the opportunity zones communities. So this is what I would like to inspire all of you, whether you are a big corporation or individual investor or just a person trying to get educated, is to be, if you do this, to find a way to positively benefit the community, because that's what it's supposed to be. Most people are not going to do that. They're just going to do the deal, if you will. What I'm hoping to inspire you to do is not to just do the deal, to bring tangible, specific value to the zone within the framework of what you're doing. And you all can figure that out. But I think if we all actually did that, not only are we going to make money, not only are we going to defer taxes, but we're actually going to make the neighborhoods more valuable. And not just, I'm not just talking about real estate value, that the neighborhoods can be more functional, they can be more sustainable, for the residents who already live there. They don't have to get pushed out because the prices are so high and they can't get a job in that area. But hopefully we can bring a whole bunch of jobs to this area and help folks to afford what's going on in these areas. Okay, so that I just wanted to sidebar, throw that out there as you're doing these deals. Try to be a responsible member of that community and bring some tangible value to that deal, to that opportunity zone, to that opportunity zone fund, to the partnership that you're bringing, partnership that you're structuring, or that you're a part of. I think if we use that philosophy just in life, we're going to be better off. Okay. Now, here's a little bit of the complex piece. All right, the opportunity zone fund details. So the fund essentially is a parent entity that then invests its capital into the holding entity, which is the entity that owns or controls the property, business, or operation. So essentially the fund is like a parent, and then from the parent is the kid, which is the holding entity. So let's just say you structure the fund, call it East Oakland Opportunity Zone Fund. Okay, now that fund can invest in multiple projects, multiple deals. So let's say East Oakland Opportunity Zone Fund wants to invest into 2530 International Boulevard. I'm just making something up. And that's that entity that owns that property or that business. And then the East Oakland Fund wants to invest into, let's just say, somebody has a business operation that they want to fund. So the fund could then invest in that property, that holding entity, and then another holding entity, which might be a business. Okay, so the fund is the parent entity, and the holding entity is the entity that actually holds the title to the property or the business. All right, key thing to understand. And the investor is essentially investing into a group, a fund, that invests into qualified activity, and in doing so, they can defer the capital gains. Again, let's say you sold something for $1 million. That capital gains could be anywhere from $300,000 to $450,000. Not chump change, right? We want to defer that, and we've got to follow these models. If our choice of deferral is the opportunity zone route, we got to follow the right way. Now, key piece I want to bring up in this beautiful golden state of California, they do not recognize the federal opportunity zone thing. They say, hey, you're in California, you're going to pay us our taxes on any business or stock or real estate that you pay. So if you're in the state of California and you're selling a property, business, or anything, you do have a capital gain, you've got to pay that capital gain to California regardless, all right? That's a lot less than the federal capital gain amount, but nonetheless, it is something you have to pay. It still makes sense to do an opportunity zone fund, though, even if you have to pay California, because you can save a considerable amount of money by doing this, all right? So I don't want to bring that up to you guys, because that's the reality if you're in Cali. It's a great state to be in. Love the taxes to death, right? So here's the key. Another key is that in order to qualify, because of course, if you're gonna, just like a 1031 exchange, you don't just get to do what you want to do in a 1031 exchange. You have to follow some very specific rules and very specific deadlines in order to qualify that investment to totally defer the taxes. Same thing is true here. The rules are different though. So, but here's one of them, is that in order to qualify, the fund must invest a significant amount of capital into improvements of the business or the property. So if you buy a property, now there are some specific allocations for that. There's a specific formula. I won't get into that. That is where having the attorney work with you is very important, because they can spell out to you what the formula is and how you need to do it. But just understand this. You have to invest a significant amount of capital into the improvements of the property or business. So you can't just buy an apartment building and rent it out and be like, oh, we got the opportunity. No, you got to buy the apartment building and renovate it out. It must, if you buy the business, you got to put a significant amount of capital into expanding that business and improving it. And there is a formula for it. So that's another thing I want to point out. I see a lot of people missing this boat. I see a lot of agents and brokers marketing properties as, oh, this opportunity zone fund property, you just buy this property, no tax, without the full knowledge of what needs to be done and how it needs to qualify. So you guys need to take time, if you're doing this, to understand that, okay, not only if you're buying a property, but it needs to be improved significantly. Okay, and there is a formula for it. I won't get into it, but understand that that's important. Now, again, let's talk about some of the pros and cons, because there's a bunch of them. For same thing like investing in the group. Now, here's some of the pros though. You have up to 18 months to make the investment from the time that you realize the gain. Now that there were some extensions done to that as a result of COVID, the pandemic, but this in general, you've got 18 months from the time you make that investment or from the time you realize the capital gain to make the new investment. Now, you can hold your capital gains in your business account, like in a 1031 exchange. That money's got to go to what's called a qualified intermediary in the opportunity zone. You've got to hold it in the entity's account where you were operating or running the business. Now, again, talk to the CPA. If you're doing this, you need to talk to an attorney, talk to the CPA. Do not do this alone. Please don't do it by yourself. So you need to get that verified, and particularly down to the particulars of what accounts, and how, and all that. But that's one of the big benefits. Now, you also can defer capital gains completely on the new asset you buy if you hold it over 10 years. Here's what I mean. Say you sell a building, make $1 million. Now you roll that $1 million into, well, if you're in California, remember you got to pay at least 9% state tax, but you roll the rest of it into the Opportunity Zone Fund. That Opportunity Zone Fund invests and purchases a property located in the Opportunity Zone, right? Now you hold that asset for 10 years. So let's say with the $1 million, you bought $1 million property, and then in 10 years, that $1 million property became a $2 million property. We did something right. Okay, now at the end of 10 years, if you held it for 10 years, the growth, that $1 million of growth in that property is all deferred. You don't have the capital gains, you don't have to pay capital gains on that at all. If you were to then sell it, you have to hold it for 10 years. All right. 10 years goes by fast. A lot of people love to hold their property indefinitely. So for people with a loan, again, Opportunity Zone is a long-term play. This is not a short-term flip. It's not a short-term situation. This is a long-term play. All right. Now, let's talk about some of the cons, and there's a couple pretty serious ones. Technically, you will have to pay capital gains in 2026. Okay. And I put again in here, state taxes in California. You got to pay the capital gains off top of California. Well, now this is still a little bit unclear to me, but this is what I understand, is that you roll your money, and let's say in 2020 into a fund. All right. Now, you keep that money in a fund, but at 2026, you've got to pay the original capital gains that you were supposed to pay when you realized the gain in the first place. This is the biggest con I see in this whole structure, which I still don't see why they put that in there, but they did. So here's the key piece on this. The Opportunity Zone Fund is not responsible. We said again, is not responsible for the individual investor's tax liability. That is on the investor, okay? I already know 9 times out of 10, there's gonna be a bunch of people this point wasn't made clear to them, or they didn't read the disclosures that said that, oh, they have to pay taxes in 2026. So there's gonna be a bunch of people invest into a deal, and 2026 comes along and they say, hey, I invested all my money in this fund. I don't have any money to pay taxes, all right? So the key is you invest, you have to be prepared to pay taxes. Now, what would be great if you invest in one of these funds that then pays out some yield, and you can use some, if not all of that yield, to pay the capital gains liability. All right. But then let's just say you invest in something in 2023 or 2024. Understand you got to turn around and pay capital gains in that 2026. So some people say, well, why would I do this whole song and dance if that's the case? Because again, the asset you purchased with the capital gains, you hold that for 10 years. Now you don't have to pay any capital gains. That's huge. All right. But the big con of it is that you have to be responsible. So if you're the person structuring this fund, what I would advise is making sure you thoroughly disclose this to your investors. Obviously, you're going to have an attorney set this up, and they're going to put together, your package and everything. And you just want to make sure you point it out to them is that, hey, these taxes are going to be paid. And what I've seen or heard that are a best practice on this from people sponsoring the deal is that what they will do is make sure there's a reserve. So when they raise the fund, that they don't invest all the money. And the issue with that is being able to allocate that to which investor and so forth. But I think it makes sense, because let's say you have a great group going and people got to pay the capital gains and they can't. That could potentially create some problems within the group. So maybe having part of the investment held as reserves could be a great strategy for 2026. All right. They set it up this way. Now, here's another thing to consider. And I don't have this on here. Well, I do actually. Several unknowns and subject to change in the tax law. As you noted in this presentation, I talked about the Jobs Act of 2012 and then the Tax Act of 2017. Those acts dramatically changed how things are done, things are taxed, so on and so forth. In the future, there can certainly be changes to this as well. So that's a thing to consider. Although, I don't see the government completely changing and throwing this out, especially since a lot of funds have been structured, and that could be catastrophic. But bottom line is, the government can change. We can change regimes, if you will, and go into another, philosophy of doing things, and this could change. So that is a significant, con, if you will. And also, you're investing into a pooled group. Again, like we talked about before, under group investing, that could have, that could be a con. So I want you guys to understand and know, hey, there's some real pros, there's some real cons. I believe, that's why I'm doing this, that the pros outweigh the cons. All right. And so anytime we're doing an investment, anytime we're doing a deal, we're in a business, there's going to be pros and cons. There's going to be issues. The key, if we're going to make some quality decisions, is making sure that the pros outweigh the cons. All right. And then we make decisions based on that and what we're trying to get accomplished. All right. Now, let me just bust down some numbers for y'all. I'm a numbers person. So I wanted to kind of give you my perspective about, okay, what can be done in a qualified opportunity zone. So let me run through. If you had a fourplex and you sold it and you said, you know what, I just, let's try something different than doing this 1031 exchange. Or here's a kicker. Maybe you had a fourplex, and I think this comes into play, and you were trying to do a 1031 exchange, right? And you had what's called a failed exchange, meaning that you were trying to do the exchange just didn't work out. And I've actually met a couple of people who are in this boat, and then exchange didn't work out, and said, well, look, I've got to invest this capital. I sold because I'm not trying to go to Vegas and play craps. I'm trying to invest. So the exchange didn't work out, but you've got this $500,000 gain. Let's just run through. So like we said, the property's in California, you know what you got to do. You got to pay that at least 9.5% California gain. Again, talk to your CPA, but that's the at least. It goes up from there, y'all. But at least you got to pay 9.5% off the top to the state of California. And we're saying this $500,000 is gain. You may have remember, gain is the money above the profit, if you will, over and above what you invest. So you might actually have more to invest, but the 500 is the gain. So you're going to pay the tax on the gain, and 9.5% is 47.5, right? So that leaves you with not 500,000, but 452.5 to invest. And you decide to go invest into an opportunity zone fund. And let's say the fund is paying out 4% annually. Now, or earning 4% annually. It may not be paying it out. Here's something to consider, you guys. A lot of these funds are being structured simply as tax, I don't want to say tax shelters because that's not the right word, but they're being structured just so people can defer taxes. A lot of these funds are not offering rate of return. All right. I think the rate of return is important because that goes to the principle of investing. I don't believe you just want to invest to not pay taxes. I believe that's a very important principle to kind of guide you through your investing, because let's say the tax law, you do something like in the 80s, for instance, I believe 81, the tax laws were changed to where, for instance, you could buy real estate and lose money and write all of it off, right? So meaning that you got negative cash flow, depreciation, you could take all of that, write it off, and it was a great tax shelter. 1986 came along and they changed that up. So you didn't get the same write-off. You still get depreciation, but you didn't get the big write-offs that you had before for losing money. So that overnight, killed many partnerships deals, just the way things are done, because those guys were investing simply to not pay taxes. When you invest, not paying taxes or deferring the taxes is an additional benefit. That is not the reason you want to make this move. Let me say that again. Okay. And there's a lot of the funds out there are not paying a yield or earning a yield. However, there are funds that are. And I think that, is important, is critically important to what, to making sustainable fund and a sustainable group is making sure that the investors are earning an annual yield as well as the growth of the property, as well as deferring the capital gains. So in this example, let's say the annual yield, the return is 4%, and therefore you're making $18,100 on your $452,500 investment. Okay. Now, remember, we said in 2021, you gotta pay the piper. You gotta pay the piper in 2021, right? And let's just say the minimum 21%. You already paid your Fed. You already paid the state capital gains. You gotta pay the Fed the minimum 21%, which would be $105,000, right? So let's just say this though: you were earning that 4% a year, right? You're earning that money, that 18,000, for 6 years, all right? And then in this example is you would hold the investment for 11 years, right? So what happens is in year 2026, you can pay that 21% capital gains with the money you've been making off the investments. That is a critical element to wealth building, is that you pay your taxes with the money that you made off this investment. That's how I would set it up. That's how I would be thinking about this, right? I think that's a sustainable model. You say, okay, we're not going to pay you anything, and then in 2026 you have to pay your taxes. I don't think that's a sustainable model, right? You got to be able to earn some yield during this time and pay that or a portion of it with that yield. You may maybe only earn 4% 2 years, okay, but you have something in which to pay that with, okay, or maybe you just hold back that amount and invest. But if you can do this, if you can do what we're talking about, you can earn 4% a year. With that 4%, then come around and pay that capital gains. You're really using positive leverage in your investing strategy. Because let's just say you held this investment for 11 years. And now your equity doubled in value, and now you don't have any gains. So you put that 452 up, that doubled in value, and you have zero capital gains, right? But let's summarize. In general, you paid 152.5, all right? 105 in 2026 and a 47.5 in the year you sold the property, right? So you paid a total 152.5. And what we're saying here, 108 grand, 600 you paid from the yield you earned. So you covered your whole 2026 liability with the money you made off the property. All right. Now, here's the kicker. Now, your 452 grew to 904, and it's tax-free because you held it for 11 years. You held it for 11 years. Plus, after you paid your taxes in 2026, you're still getting that 4% yield. So that's another 90,000 and some change, 90,005 that you earned in your investment, and your money grew, doubled, and you didn't pay taxes. This is the power of this vehicle, right? In this model, this is what I'm seeing as a sustainable model for this type of investment, because it would allow you to pay your taxes in 26. It would allow you to grow your equity. It would allow you to still make yield and income. And if we, like I said earlier, if we took the time to actually say, what can we do as a tangible benefit to the neighborhood that we're investing in, or say it like this, the neighborhood that we're serving, not only did we make money, not only did we minimize our capital gain exposure, we grew our equity, but more importantly, we actually brought tangible value to the opportunity zone. And that's what I'm teaching and preaching, and that's what I see as a sustainable model that can be done. And so, please, if you got any questions, chat it in, let me know. Quick 1031 versus OZs, you got 18 months versus 180 days in opportunity zone. In a 1031 exchange, there's a 45-day identification period, and then you have to close in 180 days. That does not exist in opportunity zone fund. You don't have to stick to like kind investments. You can sell stocks and then buy real estate. In 1031, you got to buy deed for deed. Now you can sell apartments and buy office buildings or land and buy warehouses, but it has to be a deed. It can't even be a partnership interest in a 1031 exchange. So it's another benefit of the opportunity zone fund. However, in the fund, you do lose absolute control over investment, which if you exchange yourself into another property that you bought yourself, you would have all absolute control. Now, you also invest into a pool and don't have a deed. Okay, you're in an LLC or an entity, not a deed, if you will. And also, there's several complexities and unknowns to the opportunity zones. All right, but there's some really big pros to it as well. And this is why I believe that this could be a very great way for people who are entrepreneurs, concerned citizens, leaders in the nonprofit world, anyone who wants to make a difference can do so economically and financially in their neighborhoods and create some sustainability. And so it's something that we're doing right now. I'm working with my business partner, Paul Chambers. We've got a site, actually 2 sites on 73rd Avenue right now in Oakland. And we're forming an opportunity zone fund to acquire, well, one of the sites is already acquired, but we're going to acquire the other site. But really, we're going to form the fund to build out a development that will be commercial development. It may include housing as well. Right now, it has a food theme. We're going through the planning process, and we're going to be raising capital to the fund very, very shortly. And it's something that I think, and we're going to be following the model I'll just map out. And I think that's a sustainable way for us to do some business in our neighborhood, to employ a bunch of folks, to help stimulate business growth in this neighborhood, to make some money, defer some taxes, and then show other folks how to do it. So I hope this has been helpful. I hope this has been something that you got a lot out of. I hope you guys got some questions, and then I also hope that we can network and do business together, whether that's in an opportunity zone, whether that's in a regular real estate deal. Maybe you got a business you're wanting to expand, but let's connect, you guys. Let's do some business, and let's make these opportunity zones sustainable and profitable for the people who live in, and that can be done. Okay, so I'm gonna go to the chat and then the questions. All right. So Juan Michael was talking about that's a great book. Yeah. Michael, what's up, bro? What's going on? That is a great book. And Juan is saying been in the business 15 years. Main lane is investment properties. And Juan, I think you down in LA, I believe. I know you're in Southern Cal, but I think it's LA, right? So let me know, Juan. Type that in. Yep, correct. All good. Now, I see Ray said, okay, yes, Ray, we would love to connect with you as well. Ray, we got your email address. We're going to resend this out. And then what I'll do when we resend it out, we're going to put on there a Calendly link with schedules that for some times that can work. So if you guys would like to schedule a time to meet with me, please, when you get the email, click that Calendly link and book a time. Ray also says, I have a few opportunity zone properties in Sacramento. Hey, man, that's fantastic. And I think this is what we're talking about. And this is what we're trying to spur. Obviously, I'm running a business. I want to do business with you guys. But what I found in doing these seminars, I've been doing these seminars since 2011. It's all webinar right now, right? But what I said is, hey, I wanted to do real world information for the real estate world, the real estate community that was actionable the day you leave the presentation, meaning that we do this presentation and now you got something that you can use, versus what I see in the seminar world is a lot of people go to a seminar and then, okay, the hook is now you got to spend $15,000 to come to the boot camp, or come to the boot camp where you get the real information. So it's like you just spent that hour of your time, which is valuable to you, to get a sales pitch. You know what I mean? And there's a lot of great programs out there, but at the same time, there's just too much of that lack of information or just sprinkling of information, wanting you to cash out and then go to another program. And what I saw is that there's real investors out there that are really looking for information or looking to start and need to get something that where when they leave that meeting, not when they pay for the boot camp, but when they leave that meeting, they can take something and use it the next day and also have a connection that they can work with in the business to help them accomplish their goals. So that's kind of our thought process. Ted Brad, hey, what's up, Ted? What's going on with you, man? How you doing? Absolutely, let's connect soon. I'll reach out, man, and then we will be sending this presentation out to everyone. And Ted, this is something, let's connect. This is something that we got to do for the CID division for NARAB for sure. These opportunity zones are across the country, and we need to be active in this investment activity for sure. So I want to thank everyone. Let me just see if there's any. Let me go to the Q&A. We've got no questions in the Q&A. I really appreciate all your time. Hey, Liz, I see you out there. Thank you. Nice seeing you as well. I wish all of you the best of success. And remember, as we're going through this pivot pandemic crisis, there's opportunity, y'all. There's always opportunity. Not saying it's going to be easy. This is one of the toughest times of our lives because we've had to shift everything that we do. But find the opportunities, find ways to bring value to your community, your team, your family, and you're going to be much better off because of that. And stay tapped in with us because we're going to continue to bring this kind of information to the marketplace on a continuous basis so that we can all, there can be a leveler playing field and that we can all move forward in making our families, our businesses, our communities more profitable and sustainable.